Assalamualaikum. Welcome to lecture 20 of tax, the last lecture under corporation tax. In this lecture, we are going to go through groups of companies. So lecture 16 to 19 was focusing on individual companies. This lecture will be focusing on group of companies. So here we are going to go through what are taxable entities. Then the group relief for losses in a 75% group. So what is the definition of 75% group? What are the principles of group relief? Loss relief and group relief, planning, non-coterminous accounting periods, companies joining or leaving the group. Then we are going to go through the next group. See, one is 75% group, the other one is the capital gain group. Okay, known as gains group. Here we adjust the capital gain and losses. So definition of a gain group, intergroup transfer of asset, tax effective use of no gain no loss rule, notional intra-group transfer of assets, group rollover relief, and finally we are going to conclude with the technical articles, syllabus, and the summary. So under taxable, there are two. One is 75% group, the other one is the gain group. Okay. Now, taxable entities. Each company in a group are treated as separate taxable entity, and each company has to pay their own separate corporation tax. Okay, but if the company belongs to a group of companies, that means when you are a member of a group, there are following points that are relevant when you're calculating your corporation tax. Let us go through those points. First one, you can get your losses relieved against the group if you are the member of the same group, and you have to be a group, a 75% group. Okay, in my previous lecture where I've covered loss relief, okay, remember the trading loss, the capital gain loss, then property business loss, we were relieving against either total profit or either chargeable gain. Carry forward, carry back, current year. Here, when you are a part of a group, you are going to have this additional relief. That is, your losses can be offset with the member of another group if you both are member of a 75% group. Next, so what happens? The taxation of your chargeable gain may be reduced. Even your chargeable gain, you can get it relieved against the gains group. That means you are going to get a capital loss relief under gains group. Now, what is the definition of 75% group? 75% group is when a parent company and its 75% subsidiary. Okay, remember the companies could be either UK resident or overseas resident. A 75% subsidiary is one in which the parent company owns 75% and at least 75% profits and assets. Now, remember, even though 75% group might include both UK resident companies and overseas company, you can only get your loss relieved against a UK resident company, not overseas company. Overseas company, yes, they will form part of the group, but you cannot get your losses relieved against them. Okay. Now, so let us go through this diagram where A is owning 75% in B and 100% in C. So we know that both B and C are 75% group. A, B, C forms under 75% group. What about D? Because see, B is owning in D. What about A to D? What is the relationship of A to D? So here, A, B, C is forming 75% group. BD is also forming a 75% group. But A, B, C, D, if you combine, they do not form 75% group. Why? Look at the effective interest. The effective interest, indirect interest also has to be 75%. So if you calculate 75 into 75, it is 56.25. So from A to D, that's why D does not form part of ABC. So A, B, C, D do not form a group. Okay. Now, so this first situation, we were assuming all were UK resident. Now the second situation, let's say C was non-resident. Okay. If C was non-resident, Still, it would be a part of the 75% group, but C cannot participate in the group relief, only A and B. If A was non-resident, still the groups would be same, but the group relief would only be between B and C, not A. Note, if B owned 100% of D, in that case, A, B, C, D would form 75% group because then A will have 75% in D. Okay. Now, moving on to the principles. So, group relief is the relief of all or part of the losses of a surrendering company against the profit of one or more of the claimant company for the corresponding accounting period. So, once a 75% group is defined, parent and subsidiary are ignored. Remember, parent and subsidiary are no longer in the picture. It is 75% group. All are treated as same in the group. So, any company with a loss can be a surrendering company. They want to surrender their loss. Next, any profitable group company can be a claimant company. So if you're surrendering a loss, you are a surrendering company. The profitable company is the claimant company. Okay, the loss will be surrendered to the profitable company, the claimant company. Now, so losses available for surrender are your current period adjusted trading losses, your brought forward trading losses, provided they cannot be used against the surrendering company's own total profit. Remember, when you are bringing forward the trading loss, first you have to utilize against your own total profit. And if you cannot utilize against the surrendering company's own total profit, then only you can get it group relief. But current period trading loss, group relief, it's available for group relief. Next, unrelieved current period property business loss. Always check whether it's current period or brought forward. This matters a lot. Adjustment changes. So this is current. Current, yes. Next, brought forward business loss. This also same condition as the second one, like trading loss. If you cannot adjust against your own total profit, then only. And then unrelieved QCD, qualifying charitable donation. Okay. So they are treated as surrendered prior to unrelieved property business. Remember, if you are having QCD, this will be surrendered before your unrelieved property business losses. Because property business loss you can carry forward, but QCD you cannot keep on carrying it forward. Okay, it's wasted. It's more restrictive. QCD is more restrictive than property business loss. Property business loss, in fact, is more flexible. That's why it is better to surrender the more restrictive one first. Now, so note the word unrelieved in respect of QCD and property business loss. It has to be unrelieved. Okay, so qualifying charitable donation and property are only unrelieved if they exit the surrendering company's other profit before any loss relief. They must be set off against the company's surrendering's total profit before any remainder can be group relief. This you have to understand. Both property business loss and QCD has to be set off against the total profit before the relief of the surrendering company. Then the balance only can be group relieved. Next, the surrendering company can surrender any amount of its current period trading loss, unrelieved property business loss, unrelieved qualifying charitable donation, any amount. Next, what about the brought forward? So if it's a brought forward trading and property business loss, then they can only be surrendered if surrendering company does not have any profit. But there is no requirement for the surrendering company to claim a trading loss against its own profit first. Okay, no requirement for that. Then, so the percentage is only relevant for working out if the companies are in a 75% group or not. It will not restrict. You don't take the 75% of your losses. No. Whatever the amount of your loss, exact that amount of loss only you will get it relieved. Actual loss only will be surrendered, not 75% of the loss. It is only for deciding whether you are a part of a group or not. Then, it is assumed that the claimant company uses any of its own current period loss first. Remember, under group relief, before the claimant company takes your loss, the surrendering company's loss, they will utilize their own current period loss first, isn't it? They don't have to make a claim for this. Therefore, profits against which losses can be group relieved are the total profit of the claimant after deducting the claimant's own brought forward unrelieved trading losses, current period trading losses, current period charitable donation. So after the claimant company deducts this three from his total profit, then only the balance could be group relieved. Now, so the claimant company does not actually have to make a claim to offset their current year trading loss, but maximum group relief that can be accepted by the claimant is equal to their TTP, assuming brought forward and current year losses are offset first and for the maximum amount. So now the group relief is deducted from your TTP after your qualifying charitable donation, after QCD. Normally, in my previous lecture, you must have seen when we were doing questions for relief, we used to deduct the relief, loss relief before QCD. In this, group relief is deducted after QCD. So the corresponding accounting period is the accounting period of both surrendering and claimant that is common to both companies. Remember, it has to be common. Now, if all of the group companies have the same accounting date, it is said that the corresponding accounting period is same. Okay, it's the whole of the current accounting period of each company. Then there's no issue. The issue comes when the two companies are having different accounting dates. So there you have to adjust your group relief based on the common period. This we'll see in section 2.4. So the maximum group relief is for a given corresponding accounting period is the lower of these two. Loss of the surrendering company or TTB of the claimant company, assuming claimant company have adjusted losses brought forward and the current year losses first. However, any amount may be surrendered within this limit. Now, group relief can be claimed in addition to or instead of the other forms of loss relief that we have done. Current year, prior year, carry forward, terminal of a single company. This we have finished in lecture 19. All the other reliefs are covered in lecture 19 except group relief, which I'm going to cover in this lecture. So, a claim for the group relief should be made by the claimant company. Who has to make the claim? Claimant company, with the consent of the surrendering company within 2 years of the end of the accounting period in which loss is relieved. Same 2 years, like individual losses. Now, example 2. Here, S is having 75% subsidiary W. So this is the result. He has a trading loss, interest income, QCD. Now, warrant is the what? Claimant. So first we'll get his TTP after adjusting his losses. So first, what is it? So where parent PLC can surrender the following losses under group relief. Okay, wherein is the one who is having the losses, so he can surrender. What is that loss? Trading loss is 24,000. And if you see here, your income is 3,100 but 4,200. You are having excess QCD. Even this will be added with your loss, the difference. So you are going to have loss available for the current period loss relief 25,100. Okay. Now, example 3. So black as 75% subsidiary white. Both companies accounting difference date is March. Results has been given for the year ended 31st March 2024 and 25. So as you can see, white is having a trading loss this period. Okay, so what? So for year ended 31st March 2024, what should white do? We are not concerned about black because black has profit. But white is the surrendering company. So white has a property business income also. So he can offset that 90,000 loss against 4,500 and then surrender the balance. Okay. So if you see here, he can offset the 4,500 against the property income, business income, and then surrender. Up to this much, you see the claimant company's profit TTP 43,500. So up to 43,500, he can surrender its losses to Black Limited. Now this is a loss memo you have to do. You had 90,000 losses, 4,500 was relieved against this, and then the balance 43,500. So 42,000 out of 90,000. 42,000 losses will be carried forward to 31st March 2025. You see, the same year you have got group relieved, the unrelieved you carried forward. Now, for year end at 31st March 2025, here, White must initially set the carried forward losses against his own TTP. Okay. Remember there was a carried forward loss of 42. So he's having this, if you add, is 24,500. So out of that 42,000 losses, it has to be set off against 24,500 of White. So White will not have anything to pay for corporation tax. He will have nil. So the remaining losses is 17,500. This can be surrendered to Black, reducing the Black's TTP. So Black, if you see, it's 85 plus 5. So it's 90,000. Out of 90, 17,500. If you deduct, you are left. So this is the TTP of 72,500. This 72,500 is for Black. Black has to pay corporation tax on this 72,500. You understand? Now, activity 1. We have 3 companies ABC forming 75% group companies. Account is 31st March. So you have been given. Okay. Now, everything is well said. Now, here, adjusted trading loss is 200,000. That's why for trading profit they have shown 0. So B is the loss making. Now, no company receives any dividend from within the company or otherwise. Company A has unrelieved trading loss brought forward 40,000. Company A. So ABC, identify the losses of B available for group relief. B, identify the profits of A and C available to relieve the losses of B. C, identify the maximum amount of group relief available to A and C and state by when they must make the claim. That's why you have to know the dates. So let us solve activity 1. So let us do part A. Identify the losses of B available for group relief. So the losses of B is 200,000. Okay. If you see B, and also there is one more thing. If you see the property business profit is 5,000 for B and QCD is 8,000. The excess, so it's unrelieved. So if you see the difference between 5 and 8 is 3,000, right? So you can add here uh, let me put it here. Trading loss and excess QCD is 3,000 and trading losses 200,000. This is part A we are doing. So the total is 203,000. Okay. This is the losses. So when we get it relieved, so if we go here, you see B has a property business profit 5,000. So B can first relieve out of 200,000 loss, he can get it first relieved against the 5,000 under the current year rules. So if he has done that, still the amount available for group relief would be 203,000 only. The only thing is the component part would be different. How? See, even if after he has utilized this 203,000, this is group relief, right? If we have utilized it against the current year first, that is against the property business profit 5,000, still the group relief would be 203,000 only. How? We'll see now. The component part would be different. Now, here the trading loss would be so from 200,000 we are deducting 5,000. And here excess QCD would be, you see, it's 8,000. That would be wasted because if you relieve 5,000 against the 200,000 loss, So your excess QCD is 8,000. You see, still it's 203,000 only. Now, coming to part B. Identify the profits of A and C available to relieve the losses of B. So from A, we are moving on to, we will keep A, part B. So when we do B, we'll keep this separate, A and C. Okay, now we will be having the trading profit, brought forward trading loss, then we have the non-trade interest, then we have the chargeable gain, then we have QCD, and then the profit. Remember, whatever the profit would be there for the group relief. So for A, the trading profit, if you see here, is 300 and 130. Then brought forward trading loss for A is 40,000 minus 40. We don't have anything for C. Now I'm going to do the sum function and take the total. Then the non-trade interest, 10,000 and 6,000. Then the chargeable gain is 20,000 only for A. Again, sum function. Now we have the QCD. So QCD, we only have 15,000 for C minus 15,000. Then the sum function. Here. So 290,000 and 121,000. These are the profits available to A and C. So for maximum available, now, so the maximum profit that is available for group relief in A must assume that all brought forward trading losses are relieved by the company before any losses surrendered by another company. That's why we have deducted this 40,000 first, isn't it? And so that means out of the 290, 200,000 was the loss, right, of B. You see, 290,000 he has the profit. So he can get the entire amount relieved against A's profit. Then A will be left with only 90,000. Right? And also group relief is after QCD. That's why we have deducted QCD. So for C, entire amount you cannot get it utilized because it's just 121,000. Still, after utilizing this, B is going to have some unrelieved losses. Now, part C, maximum amount of group relief available to A and C. You have to identify. So when you have to identify, remember, it is the lower of loss of A and profit of A and C. So when you come to C here, lower of loss of B, because B is the surrounding company, and profit of A and C. So what is the loss of B under A and C? Loss of B is 200 and 200, sorry, loss of B for corresponding accounting period is 203,000 because you have unrelated QCD as well. Loss of B will remain the same. Now the profits of A is 290 and here is 121,000. So in this case, the lower is loss of B. This is the group relief, and here profit of C is the lower amount. So this would be the group relief. This two amount, this and this would be the answer. Okay. So now there are combinations. Either the entire loss of 203 could be adjusted against the profit of A, or utilize entire 121,000 against the profit of 121,000 C and the balance 82,000. So from 203,000, if you deduct this, you are left with 82,000. Then the balance 82,000 you can utilize against the profit 290,000 of A. That also you can do. The two ways. And the third way, so there are other combinations also. Okay. So either, let's say for example 150, so that 203, out of 203, 150,000, that's just an example, any figure you can give. 150 from A, so because he has profit of 290, and the balance 53,000 from C's profit. Okay, because he has sufficient profit. That also, in that way also you can do. Now you have to state the date when you have to make the claim. So within 2 years, it is 31st March 2027. So you have to make the claim within 2 years from the loss making period, 31st March 2027. Okay. So the answer for activity 1, as you can see, excess QCD we are adding with the 200,000 loss of B, 203,000 is the loss. So we can get it relief against the 5,000 of the property. Then you will be having excess QCD 8,000. And now this will be a trading loss. Still the group relief is 203,000 only. Coming to part B. So the profit of A and C. Here you have to deduct the brought forward loss first and QCD first before group relief. So the maximum amount is 290 and 121,000. Now C. So this is the lower amount, the loss of B compared to the profit of A. And here the profit of C is less than the loss of B. So these two are the amount for the group relief. So here they have given you three combination. The whole loss can be set off against A, or 121 max against C and then 82 remainder against A, or 150 against A, 53 against C. And you have to make the claim by 31st March 2027 from the 2 years from this date, corresponding accounting period. Now moving on to, so because now there are two-tier corporation tax system, two rates, 19 and 25%. Most important factor when you're considering the loss relief and the group relief is the rate at which you're going to get the relief. There are other factors, but they are less important, like your timing and cash flow. So it's better to get the relief earlier because it's going to improve your cash flow. And also the extent to which you're going to lose your QCD, because QCD you cannot get it relieved. So these are your factors. These are the same factor for your normal loss relief also, and same for the group relief. So as explained in lecture 19, any claim made against your total profit before 1st April 2023 will obtain the rate 19%. Now, current and the prior relief against total profit cannot be restricted. They are all or nothing. But when it comes to group relief, it's more flexible. Okay, there's more flexibility when it comes to group relief claims and loss relief claim against future total profit. So group relief can be restricted, so the surrendering company retains sufficient losses to bring its own augmented profit down to the lower limit. Remember, surrendering company surrenders their losses to the claimant company, right? But surrendering company can now retain some losses, at least to such an amount that it will help him to bring his augmented profit down to a lower limit. So he has to pay lower tax. Now, planning. What is the objectives of planning loss relief? To minimize the group corporation tax charge. Two, to avoid unnecessary carry forward of unrelieved losses. So now the examination approach. This is the following approach you have to use in your exam when you're solving uh, group relief. Look at the group structure. First, identify the companies that belong to a 75% group and who can participate in that group relief. Very important. Once I've identified, identify trading and other losses given in the question. Then, 3. Work chronologically. Deal with the earlier losses before the later losses. Then, fourth one. You have to give priority to the losses that can only be relieved in specific way. For example, capital loss only against chargeable gain. There's no other way. And the fifth one, where a loss can be relieved in several ways, like your trading loss. You can carry forward, carry back, current year. So here you have to identify and determine the maximum. If you are okay, for example, current year and group relief, you have to determine the maximum limit for the group relief for each claimant company in order that QCD is not wasted. So this is planning. If you follow the structure, you will never go wrong. Sixth, if the relief can be restricted, then it is better to claim initially against the profit that is subject to 26.5% rate. Okay. This raise will vary if the company has dividends that are not from 51% group company. So the amount relieved should be sufficient to bring augmented to lower limit. The next tranche of relief should be against profit subject to the full corporation tax that is 25%. Seventh, you have to ensure that your QCD is not wasted when you're relieving the losses. So let us go through example 4. Alpha is owning 4 companies: B, C, D, E, Beta, Delta, Beta, Charlie, Delta, Echo. Now, this Beta, Delta, Echo, Alpha, they form a group because all are 75% group. But what about Charlie? No, Charlie does not come because Charlie, if you see, from A to C is 60, from B to C is also 60%. So it's less than 75, it does not form the part of the group. So all of the companies are based in UK except Delta. Delta is a resident overseas. See, Delta is a part of a group but cannot get its losses relieved. Now he can transfer the loss to the group, or now the group losses he can take. Okay. So here you have been given the loss. So here 2 companies are making loss. One is B, one is C. So if you move back, you see C is not a part of a group. So C's 150,000 loss cannot be group relieved. Now he has any other profit. But we are more worried about Beta. Beta can give to A, Beta can give to E, but not C, not D because D is overseas. Understand? And here we have one dividend from non-group companies. This we need for augmented profit to adjust. Now, so the group wish to maximize their tax repayment from the losses and get the benefit of any remaining losses as soon as possible. So Beta has a taxable 10,000. And now Alpha, Beta, Delta, Echo, A, B, D, E, all these 4 form a 75% group. But Charlie is not in the group because effective interest is only 6%. So Charlie's loss of 150, you can carry it forward and set off against the future profit of Charlie. As Delta is not a UK resident, you cannot benefit from the group relief claim. So now, even though Charlie is not in the group for the group relief, but it is still an associated company. Why? More than 50%, greater than 50%. It's an associated company. So, how many companies are there? 4 from the group and 1 Charlie. So, 5 associated companies are there. So, because remember, your upper limit and lower limit is reduced by divided by the number of associated company. So upper limit was 250 divided by 5. Lower limit is 50 divided by 5. Now your lower limit is 10,000, upper limit is 50,000. You have to compare augmented profit with this. Now, so beta has the following options, because beta is the having loss. Either set off against the current year and prior year. B, carry the loss forward. C, group relief the loss to alpha or ACCA. Or D, combination A, B or C. Okay. Now, so as the group wish to maximize tax repayment, what should they do? Carry back. Okay. Tax repayment, you have to consider the rate of corporation that are payable by the group companies. So beta can carry the loss back to set up against the profit of the year ended 31st March 2024. But if you do this, what happens? He will only save tax at 19%. And they are liable to corporation tax at 25% in the current year. So currently, when are you making the loss? 31st March 2025. Okay. So for this year, 25% you have to pay tax. But when you go back 1 year back, the corporation tax was 19%. So you could only save tax at 19%, which is not wise, right? You are paying more tax, you are saving at a less amount. So if you see alpha and ACCA, they are also liable to corporation tax at 25% before any group relief claim. So now what should he do? Rather than carrying it back, beta, who is having the loss, should consider surrendering their losses to two companies, A and ACCA. Okay, let us go back and see A and E. So if you see A and E, A is having an adjusted trading profit 200 and C is having a 50,000. Okay, and property business. So C is slightly what? Above the limit. So better to set off against E to bring down his augmented profit. Okay, so should surrender sufficient losses to E to reduce his augmented profit down to the lower limit. You see, now the lower limit is what? Lower limit has been changed. Lower limit is now 10,000. And if you go here, 50 and 10, 60, and from 60, 15. So you'll be left with 45,000. So try to bring this to 10,000. From 130,000 loss, if you adjust 35,000 loss, his limit will come to 10,000. It will come below the lower limit. So what happens? Set off against E, so that his augmented profit you can bring down to the lower limit. Although B cannot restrict the loss relief. See, you cannot restrict the loss relief made against his own total profit. But for group relief, you can do this. Okay. So he can balance, he can get it relieved against alpha. That leaves sufficient unused losses to bring the augmented profit, not the TTP down to the lower limit. Now, so this is what's happening. A, B and A. So we are going to make the adjusted trading profit. B is having the loss of 0. Then property business. And then the total profit. Then you get the loss relief. Okay. As I told you, you want to bring your TTP down to lower limit for E, 10,000, right? You have 45,000. So the balance 35,000. Get it relieved. Okay. Done. So for B also, you will want to bring its augmented profit to 10,000, lower limit. So to bring the augmented profit, see, dividend is already given as 3,000, right? You have to bring your TTP to 7,000. How do you do that? You already have 50,000 profit. So the loss relief is the balancing figure, 43,000. So 43,000 has been adjusted, 35,000 has been adjusted. The balance is 52,000 because the loss of A is 130,000, isn't it? So out of 130, 43,000 is relieved. So first 35,000 is relieved against E. The next 43 is relieved against B. The balance 52, 3 will be relieved against E. You understand? And then you get the DTP 148,000. So here A has to pay at 25%. But this 10,000 is lower limit, so B and E has to pay at 19%. Okay, corporation tax. Now what happens? So this is the memorandum. You have utilized 43 current and 87 is the group relief from A and C. A and E, sorry, Echo and Alpha. So what did you do? That 43,000 of beta's loss should be used to reduce their own augmented profit to the lower limit of 10,000, leaving 87,000 for group relief. Out of that 87, 35,000 you have relieved it against E so that you can bring his TTP down to the lower limit, and 52 the remaining against A to save tax at 25% because he was paying tax at 25%, hasn't it? So that's what we have done. Now coming to accounting periods when they are not same for the group, what should you do? You have to adjust. If the period is common for both surrounding and claimant, no issue. The issue comes when it is not same. Then you have to apportion your profit and losses. Let's say surrounding company has a year end of 30th September and claimant company is preparing account to 31st December. How do you do that? So the maximum loss for group relief will be this. Remember this fraction. This is going to be very important. Loss of your surrounding company into corresponding accounting period divided by accounting period of surrounding company. So this is loss of surrounding company, accounting period of surrounding company will be here. You see, this is how you remember, and this is the corresponding accounting period. Now, maximum profit for group relief purpose will be, this is the maximum loss. Loss of whom? Surrounding company. So now we are moving to claimant company. Profit of claimant company into corresponding accounting period divided by accounting period of claimant company. So this is the claimant and claimant. They are same. Now, maximum amount of group relief is restricted to the smaller of these two amount. This is A, let me call this B. Whichever is smaller, that is your group relief. Profit of claimant company or surrounding company's loss. So now let us solve this through activity 2. Okay. So here surrounding company is having a loss of 24,000 because his primary account from October to September. He's having a September end. And claimant is having a 31st year end. So what do? You have to determine the maximum group relief available to claimant for 31st December 2023 and 24, assuming all losses are relieved as soon as possible. What do? See, you from this year to this year, this is your profit 20, and from 23 to 24, this is your profit 40, and you have a loss of 24,000. Okay. So when you do this, you take. So for 31st December 2023, first let us solve this. It is the lower of the two figure. Claimant company's profit and the loss of surrounding company. So if you go back, it is 24,000 is the profit loss of surrounding company. You have to take 3 months. This period they correspond. This period they correspond with each other. That is October 2023, November 2023, December 2023. So from this whole month, the last 3 months is corresponding. So you have to take 3 months. So you have to take 3 months of the loss, that is 24,000. So 3 months of 24,000, which is 6,000. This is the loss of the surrounding company. Moving to the claimant company. Claimant company's profit also you have to portion like that. You have to take 3 months of 20,000. So 3 months of 20,000 is 5,000. This is the profit of the claimant, which is lower, the 5,000. Profit of claimant. This is the lower figure. So this is your maximum group relief. Coming to 31st December 2024. Here, which is corresponding. This portion, the one which I have crossed out. You see, this portion. So how many months? 9 months. Starting from December to September. So January, February, March, April, May, June, July, August, September. This 9 months are corresponding of the surrounding and the claimant. They are common. So 9 months of 24 and 9 months of 40 you have to take now. If you see which is lower, this time it is the loss of the surrounding company. 18,000 is lower than 30,000. And remember, this time the profit is 40,000 because this year ended 31st December 2024. But the loss remains the same, 24,000 only. So it's very easy. This is how you work. Now, moving on to companies leaving and joining the group. Here, a corresponding accounting period starts when a company becomes a 75% subsidiary. A corresponding company period ends when a company leaves the group. Okay, so if they are not the same, time apportion losses and profit. Now, activity 3. Facts as in activity 2, that means 24,000 loss and 40,000, but except the surrounding company joined the group on 1st Feb 2024. So it starts from February. Earlier there were 9 months, now 8 months. So now only thing is it changed to 8 months. Loss is same, 40,000, profit is same. This time the lower is surrounding companies loss. Okay. Now, when company is leaving, same fact. Now they are leaving 31st August. So from Jan to August, how many months? 8 months. For year ended 31st December 2024. Now, here it would be 3 months only because they were in the group. So 5,000, the profit of claimant and the loss of surrounding is the lower amount. Because they told for December 2023 and 24 you have to find the maximum. So that's what we have found. So now we are moving on from the loss relief, loss group to gain group. Definition of a gain group. This is also 75% only, but this is 75% chargeable gain group. Here we have a parent company having its 75% subsidiary, provided there's a 75% holding at each level, and effective interest has to be over 50% if it's a subsidiaries. A company can only be in one chargeable gain group. Remember, when you are in a gain group, not gain group, loss group, okay, group relief, you can be in any group. You can be in 2-3 groups, but when it comes to gain, chargeable gain group, only one chargeable gain group you can be a part of. Even though you can be a member of more than 175% group relief group. This and this chargeable gain group and 75% group relief group are different. 75% group relief group are more flexible than chargeable gain group. Chargeable gain group, you can only be in one chargeable gain group. So here also company could be UK resident or resident overseas, but only UK resident companies can offset their losses, not the overseas resident. Now, example 5. So P is having 75%, then again 75, again 75. If you take S1, S1 will form part of the group with P Limited. Okay. And if you look at the effective interest, 75 into 75, it is 56.25. Greater than 50 is a part of the gain group. But 75 into 75 into 75 is 49. It's less than 50. So only this P, S1, S2 form part of the gain group. Okay. All companies are UK resident is assumed. So these three companies will form the gain group. Okay. S2, if you see S2 and S3, these two, they're having 75%, but they cannot form a separate gain group. Remember, only one gain group. You understand? Now, what happens when there's a transfer of assets within this gain group? So where a capital asset is transferred between companies within a gain group, it is said that transfer would be at no gain, no loss, because actually you're not making any gain because it's within the group only. You're not transferring it to the outsider. So the proceed will be equal to the cost to the transferor company plus the indexation allowance to the date of the intragroup transfer. Now, the intragroup no gain, no loss is the same as applied to spouses. Interspouses transfer between married couples. This I've covered in lecture 12 when I was explaining you capital gain tax. When I've introduced you to CGD, I've told you any transfer among the spouses also at no gain, no loss, where the cost to the spouse is disposing would be the cost. So the proceed of the spouse, cost of the spouse who is transferring would be the cost of the spouse who's taking over. Except there that time indexation allowance was not added because that was not a company. Here indexation allowance is added because it's a company. Now, so when there's a subsequent chargeable disposal of the asset by the transferee company, then a chargeable gain you have to calculate. Chargeable gain or allowable loss arises. Then you compare it with the open market value with the deemed cost to the transferee company. This deemed cost is the same as the deemed proceed to the transferor company. So if the gain arises, a further indexation allowance will be given for the period of ownership of the transferee company based on the deemed cost. This will be given to you in the question, don't worry. No gain, no loss automatically will apply in the gain group. Automatically. You don't have to make any claim. Now, activity 5. So in activity 5, there's a transfer of asset. You have been given the allocation factor, indexation factor. Now, G is owning 80%. So G and F are 75% gain group. Now, 20th Feb, land costing 125. G transferred the land to F on 15 July 2012. Market value was 159. F sold the land to third party for 296. The moment he sells it to third party for 296, that is the time he's making a profit. Not when G is transferring to F. Calculate the chargeable gain. So you see here, first intergroup transfer. No gain, no loss. So your sale proceed would be the cost to the G plus the indexation. And the market value is ignored. Okay. So what is the proceed? The proceed was 296,000. This is the sale proceed. Because that is the time you are doing the gain, okay? Intergroup transfer, no gain, no loss. But when you're selling this time, proceed is 296. And this you have to find the cost. Once you find the cost only, you can apply the indexation factor. So let us go to the working to find the deemed cost to be. What is the cost? First time you bought it, cost was 124,000. With that, you will be adding the indexation factor, which is this. What is it? From the time you have owned till the date you have transferred. You have transferred it in July 2012. So 0.209 you have to use, which you have used here. Added, this is the deemed cost. So this deemed cost you will deduct from the sale proceed. And then from July to December, because you are selling it in July 2024. So you will be using this indexation factor. This you will deduct. And this is the chargeable gain. Now, tax effective use of the no gain, no loss rule. The no gain, no loss could be used advantageously to realize the capital gain and the losses on the sale outside the group in the same company. so that immediate loss relief is obtained. Okay. However, it is easier to do this retrospectively with a notional intragroup transfer, which means no expense are involved in transferring the actual asset. Can you understand this? So bring the gain and the loss to one company when you're doing it in the group, okay, rather than actually transferring the asset, because there are expenses involved when you actually transfer the asset. It is known as notional intragroup transfer. So when you bring the gain and the losses to one group, one company, it's easier. That loss will be offset against the gain. So immediate loss relief is obtained there. Okay, now here capital losses, remember you cannot get it group relieved. Capital loss you can transfer, but you can make an election to transfer the assets between the group companies. If you transfer the assets between group companies, what happens? No gain. It's at no gain, no loss. Okay, such that if you are making, when asset is transferred, such that chargeable gain or capital loss arise in the same company. If this happens, asset does not have to be moved between the companies in the gain group. So you make a joint election so that the matching is done on a notional basis. Joint election you have to make within 2 years from the accounting period in which the asset was disposed of outside the group, and will specify which company in the group is treated for tax was made the disposal. That means you will write which company is said to make the disposal in the group so that he will be charged to tax. Okay. So what happens is this is like when you just transfer the assets among the companies, group companies, so that it arises at no gain no loss, so that the gain and the loss are incurred by the same company. This happens when they are making a disposal outside the group. Okay, now advantage of this notional basis over the nominal basis are you can done the plan retrospectively. Planning can be done after the gain and losses has been realized on external group transaction, and thus the outcome is assured. You know the outcome. So remember, this retrospective application comes after gain and losses have been realized on external group transaction. That means someone have sold outside the group, have realized a gain. Now what happens? Bring the loss to that so that his gain will be offset by the losses of the group company. So the election, so for that to happen, you make an election. So you have made an election to apply to whole or part of the asset. Then the transaction costs of actually transferring ownership within the group are avoided. Now, rolled over relief. An extended application of rolled over relief means a chargeable gain can be deferred without obligating the same company to make appropriate reinvestment. See, in the group, same company should not make the reinvestment. Any company from the group is made the reinvestment, rolled over relief will be given. So all the companies in the gain group are deemed to conduct a single trade for the purpose of rolled over relief. Rolled over relief applies where one group company disposes a qualifying business asset and another member of the gain group acquires a qualifying business asset within 4 years. So you can see lecture 15 for the detailed version of rolled over relief. Now that's it for this lecture. So we have task section E, the fifth part of the group structure. We have defined 75% group and recognize 75% chargeable gain group and the exemptions. Then each company in a group of company are separate taxable entity paying their separate corporation tax, but in terms of losses group, okay, they can get their losses relieved among their group members if they are part of the 75% group. Okay, and both UK resident company and non-UK resident company can be a part of a 75% group, but overseas company cannot offset their losses with the UK companies. And group relief. is a relief of all or part of the losses of the surrounding company against the profit of the claimant company for the corresponding accounting period. Accounting period has to be common among the surrounding and the claimant. If it's not, you have to apportion. We have done it, right? Losses available for surrender are current period trading loss, brought forward trading loss. But if it's a brought forward trading loss, make sure that first it was utilized against the surrounding company's TTP. Then unrelieved property business loss, brought forward property loss. Again, same thing if it was not utilized against the total profit of surrounding company. Then unrelieved QCD when it exists total profit. These are the losses you can surrender under group relief. Then when you have QCD, they are surrendered before unrelieved property business losses. QCD and property business loss you have to set off against the total profit before the remainder can be group relieved. Then the brought forward trading and brought forward business property can only be surrendered after the surrounding company is unable to use the loss. If the claimant company, assume claimant company is using their own current period losses first before group relief. And maximum group relief for the corresponding accounting period is the lower of surrounding company's loss and the claimant company's profit. Corresponding accounting period means period which is common to both the companies. And group relief can be claimed instead, as well as or instead of your other forms of loss relief that were available for single company. Now, losses and profits you have to time apportion when accounting periods are not matching, and also when a company joins or leaves the group. A gain group is also 75% only, but here at each tier you have to satisfy the 50% interest in effective interest, not 75%. Okay? And when asset is transferred among the gain group, automatically no gain no loss rule will apply. This can be done on a notional basis. And rolled over relief. So conditions for rolled over relief can be satisfied by any member of the group. That means one member is purchasing the reinvestment, the other one is disposing the asset within 4 years. So in this lecture, the technical articles you have to read is groups. Thank you for watching, and I shall see you in the next lecture, that is inheritance tax. With this, I have finished my corporation tax. So up to now, I have finished 3 taxes: income tax, lecture 1 to 11, lecture 12 to 15. I have finished capital gain tax, lecture 16 to 20. I have finished corporation tax. And now my next lecture, lecture 21, will be focusing on inheritance tax. That is the only one lecture which will focus the entire inheritance tax. And finally, the final lecture, lecture 22, which will focus on VAT. So now I have finished the 3 taxes. Make sure that from your revision kit and past paper, you do questions on this 3 type of taxes, that is your corporation tax, income tax, and capital gain tax, because they are interrelated with each other. Thank you for watching, and do not forget to subscribe to my channel if you haven't, and my previous lectures you can watch under my tax playlist. Thank you.